Hello and welcome to the Editors Roundtable. I'm Sonia Shenoy, with me Nimesha and Nigel D'Souza. Also on the show today with us is Devina Mehra, the founder, chairperson and managing director at First Global. Devina, thank you so much for joining us. So, as we were discussing, right, there are signs and perhaps a correction is overdue as well, but it hasn't come yet. So as an Indian market investor, what do you do now? Do you get cautious? Do you raise your cash levels? Or do you continue to ride this rally?
Well, hi and good afternoon to you and your viewers. If you wanted in one line, I would say get out of the frothy areas of the market and get into a steadier portfolio. You need not go into cash necessarily, but there have been pockets in the market, which all of us know of, where there have been excesses, whether it is in market cap categories, whether it is in themes, whether it is in new offerings, whether of stocks or of funds, I would say, even some of the NFOs in the areas where they have come up. So those are the areas where you should take some money off the table and put it in a steadier portfolio. That would be my number one advice.
So, okay. Devina, when you say steadier portfolio, if you can just tell for our viewers, which are the sectors that you are quite bullish on at this point in time and would like to incrementally add money into those sectors?
I missed out part of the question. So you're saying incrementally add into which sectors? Is that the question?
Correct. Which are the sectors where you feel comfortable?
So I'll tell you what we do.
Sure.
Okay. So in July, we do a quarterly rebalance of our PMS portfolio. So from base zero, where would we be if we had money today, if we had cash today? And so there were some themes which continued. So we have been overweight, for example, in autos and pharma for the past year and a half. In the beginning of 23, we added more there, auto components in particular, more than autos and pharma. Capital goods and industrial machinery, we got in much earlier than most other funds and investors, which is almost 3 years ago. In October 21, we have been cutting and booking profits, but we are still a little overweight. Sector which we were slightly overweight. We went even more overweight in the last rebalance was IT. And a sector which had kind of disappeared from our portfolios for almost 2 years was chemicals, and that made a comeback in our systems. A number of chemical stocks went up high, so that's a sector where we made fresh investments. We remain where we are underweight. We remain underweight banks, but the change of late in the last 2 quarters has been that we moved a little from the PSUs to the private sector. Still underweight, but the relative weights changed. Surprisingly, this time, a lot of the other non-lending financials our systems did not like. For example, stock exchanges or AMCs or broking related stocks. So we just because they fell so much in our rankings, we got out of most of that. So that would be the broad pattern of what we did this time, where we are overweight, where we are underweight. We are quite a bit underweight things like energy, utilities, and things like that. So that's one more segment.
Well, Devina, I wanted your view on this. We keep talking about the maturity of the Indian investors. We keep talking about the domestic flows have been rock solid. Are we getting a little too comfortable? Because if you dissect those flow numbers as well, throws up various results. What's your view, Devina? 2007, 2008, that was when I started tracking markets. But you all would vividly remember that period. Tell us more.
Yeah, so let me go back even further. You gave that 1993 example. So yes, there was a lot of market movement around that time. But you must remember that from 1994, which interestingly is also the time that the FII flows into India started in earnest. There was a whole 9-year streak from 94 to 2003 when the net movement in the market was zero. It went up and it went down, but ultimately over 9 years, the index movement was zero, a whole 9 years. And this, for all the people who track flows, this is also important to remember that with this fresh slew of FII money coming in, no mutual fund market, to speak of in India, no, very little retail participation, still it didn't move the market. But this is the postscript to that is this, that after that 9 year of no net displacement from 2003 to 2007, the market went up 6 times, which was also part of a general emerging market move because the emerging market index itself went up 3.5 times, Brazil went up 10 times, and so on, at a time when US was struggling. So that was the move. That 2003 to 7, it was a 6 times move for the index. So yes, after that it fell. But then, this also gives you perspective as to how movements can happen. And as this is a statistic I've quoted earlier in my interviews also with you, that 2010 to 20 was again a period while, it's not as if there were zero returns, but there were very low returns. There were returns which were barely matching fixed deposit returns. So if you had put in 100 rupees at the beginning of the decade at 2010-11, you would have made only 230 rupees at the end of 10 years. As against 1980, you put in 100 rupees, that went to 700 rupees. So this was what created this subnormal return for a whole decade, just about, not even 9% at a time when fixed deposit rates were 8%. That created the room for this bull run, which is why I'm saying that for the large cap, for the mainstream indexes, I am still not negative on a sustained basis. There can be interim volatility, but I don't think we are at the high end. So, that 2007 and 93, there's a context to it. So 2007 was after a 6 times move in about 6 years. So
correct.
That was the context.
Okay. Devina, you want to comment on that? Of course, this is something that's long coming. I mean, there are a lot of regulatory issues as well that NSE has been facing. But as and when the listing happens, it's going to be big, especially for shareholders, right? Any thoughts on how to approach this one?
I haven't really studied the numbers, so I would not like to comment on that. As I told you, this whole category, our systems did not like, and partly the reason could be some amount of regulatory overhang which might change the dynamics. And so I agree that this is a real risk, and as it should be. I mean, because the derivatives volumes, the way if you see over 5 years or 6 years, the way it has gone up, it doesn't make any sense. And obviously everybody is losing money, which they refuse to recognize, and because human beings don't understand probability. So you're essentially playing a lottery, and you know for certain that the expected value of doing this is negative, but you think you will be the exception. So I mean, those things are there. Overall, I would say in the IPO market, India is a capital-starved economy. So any time any window of capital raising opens, then first the good guys come, and then a whole bunch comes, which is a mix of good, bad, and really ugly. So that's what's going on overall here. I see I'm not talking about the NSE IPO, obviously, but I'm saying IPOs in general, or even fundraising in general. I was looking at the QIP data. QIP raising this year in the first 6-7 months has been as much as what it was for the whole of last year, which itself was a huge jump over 2022. So anytime there's a capital available, Indian companies probably from the company point of view, rightly so, just go and raise money. I mean, when GDR market, which people have long forgotten, opened in the 90s, and so many Indian companies went there as global depository receipts, and I looked at the data, and I found that of the entire global GDR market, it was 90-95% Indian companies. So, that's the danger when there are too many companies raising money. I even hear some analysts saying that so-and-so is doing a QIP, which is a positive, and that's not the filter to look at, because QIPs typically mean dilution and return ratios, which is not to say that QIPs never make sense, but I'm just saying that there's too much fundraising going on overall.
Yes, Devina, exactly. That's why I wanted to ask the next question to you, especially in the real estate sector. As you rightly pointed out, there are a lot of companies which are raising funds, especially in the real estate names. This week, in fact, today itself, we saw 2 companies raising money by QIP, and pretty large sum. In fact, the entire real estate basket has raised money or in the pipeline of raising money. Your view on the real estate sector stocks, and is there in part of your portfolio right now?
No, they are not part of our portfolio, so which is why we are not looking at it very closely. It's a risky sector, and as a philosophy, as a house, and how we manage portfolios, we first try to avoid big risk. So this is not a sector that we have ever held in great size. And, given the nature of the sector, I mean, it's no wonder that people are raising money because, that's the way to do it in this market, that money is available. So you may as well raise as much as possible.
Devina, before we let you go, you were telling us about what your view is on the markets. But if this correction does set in, then any couple of sectors or stocks or, pockets in this market that you think are worth investing into now?
Yeah, I told you where we are overweight, which is auto components, pharma, a little bit of industrials and capital goods, IT. Those are the places where we continue to be overweight to a greater or lesser degree. But as I said, be careful. And I was listening to the talk on block deals. That's another area where, aggregate numbers are very high. I'm not one of those who always think that insider selling is bad, because obviously everybody does and should diversify their net worth if it's locked up mostly in one company or one group. So that's a sensible thing. But on the aggregates, when the numbers are this large, it shows froth, at least in some areas of the market.
Okay.
And real estate, I was saying, anecdotally, I don't find people being able to sell their existing flats at anywhere close to what the numbers are being quoted in the market. So,
That's true.
Got it. All right, Devina, we appreciate you joining in on the show. Thanks a lot for joining in, and we look forward to chatting up with you